Section 2. Futures contracts. Essentially, the futures contracts are the standardized forward contracts. The purpose to introduce such contracts is that they can be traded on an exchange so that individuals do not need to find an appropriate counterparty, and more importantly, they do not need to face the counterparty's default risk. Formally, a forward contract traded in an exchange is called a futures contract. There are many exchanges-traded futures contracts, such as Chicago Board of Trade, Chicago Mercantile Exchange, Singapore Exchange, Shanghai Futures Exchange, etc. They dictate the terms of the contracts and fix the size and maturity time. All exchanges employ a mark-to-market mechanism for trading of futures, which works as follows. First, the investor needs to open a margin account with a broker. Then, for trading of each futures contract, one is required to deposit a specific amount of cash, called the initial margin. This account is marked to market at the end of each trading day on the gain and loss of holding the futures position. And therefore, the value of this account fluctuates from day to day according to the daily changes in the futures price. If the account balance drops below a prescribed threshold, the so-called maintenance margin, which is about 70% to 80% of the initial margin, the investor is required to top up with cash, and this warning is called margin call. Here's an example of how this mark-to-market mechanism works. Suppose an investor takes a long position of one futures contract in corn. The contract size is 5,000 bushels, and the delivery price is $2.1 per bushel. His broker requires an initial margin of $800 with a maintenance margin of $600. The daily close prices of the futures for the next two trading days are $2.07 and $2.05 respectively. Now let's work out how this mechanism affects the investor's margin account. At the close of the next trading day, the price of the futures drops from $2.1 to $2.07 per bushel. This represents a loss of 3 cents per bushel, and that is $150 per contract. The broker will thus take this amount from the margin account, leaving a balance of $650. At the close of the following day, the price drops further to $2.05 per bushel, and this represents an additional loss of $100 of this contract. Then, the margin account drops to $550, which is below the maintenance level. The broker calls the investor to increase the margin account to at least $600. Failing to do so, the investor's position will be closed out. This example shows you how the mark-to-market mechanism updates the margin account daily. And in fact, this mechanism results in the futures contract being reset to having value 0 at the end of each trading day. The benefits of employing such mechanism with margin account are: first, the maintenance of the margin account guarantees that the holder of the futures will not default on their obligations. And second, the daily accounting of gains and losses avoids the tedious bookkeeping of contracts with different delivery prices. In a nutshell, the difference between the forward and futures is that the futures contracts involve intermediate cash flows, while the forward contracts have no intermediate cash flows until the final payment at maturity. However, as we have mentioned in the beginning of this lesson, the futures contracts are just the standardized forward contracts. Then here is the question: are forward price and futures price the same for contracts on identical terms? The answer is yes. Assuming zero transaction costs and no margin is required for futures contracts, then we have the following futures forward equivalent. Suppose that the interest rates are known to follow expectations dynamics. Then the theoretical futures and forward prices of corresponding contracts are identical. To prove this equivalency, let's introduce the following notations. Let G0 be the forward price to be paid at delivery time T. Let djk denote the discount factor at time j for a bond of unit par maturing at time k, where k is greater than j. Let F0, F1, all the way to F T be the futures price at time 0, time 1, all the way to the delivery time t. Note that at the maturity time T, the futures price must equal to the spot price. That is, Ft is equal to St. Now let's consider two strategies. Strategy A is a dynamic strategy specified as follows. At time 0, go long D1T unit of futures. At time 1, increase the position to D2T unit. That is, at time K, increase the position to dk plus 1t unit. And all the way to time t minus 1, the position is increased to 1. Here we assume the additional futures acquired at time k is entered at price fk. Then the profit at time k plus 1 from the previous period is fk plus 1 minus fk times dk plus 1t. That is the difference of the futures prices times the number of units of contract on hold. As we have emphasized, the above factor dk plus 1t is to be interpreted as the number of futures contracts, but not for a discount factor. And note that the above profit or loss at time k plus 1 is invested in or financed by the interest rate market until time T. That is, zero net cash flow at each step. And thus, the profit or loss at time k plus 1 grows to fk plus 1 minus fk at maturity. Then, the total profit or loss for this strategy A can be calculated as follows. Strategy B is to hold a long position in one forward contract, and its final profit is St minus G0. Note that for both strategies, there is no requirement on initial investment. Now let's consider the combined strategy A minus B, that is, to long strategy A and to short strategy B. This combined strategy requires no cash flow until the final period, and the corresponding profit or loss is profit A minus profit B, that is G0 minus F0. This profit amount must be equal to 0 to avoid arbitrage, as there is no initial investment required to construct this combined strategy. Therefore, we have G0 is equal to F0, that is, the forward price equals the futures price. While we have showed the equivalence of the forward and futures prices, it is worth mentioning that the interest rates are hardly deterministic in real life. However, the difference is small over a short time period, such as a few months. In the next lesson, we're going to see a concrete example on a comparison of a forward contract and a futures contract.